Welcome to another weekly market video commentary. And today I really want to focus on volatility because it is the topic of the day, the month, the year, really. And equity markets, especially as it relates to the S&P 500, are likely to surpass the June lows that we experienced this year in 2022. And although that can undoubtedly be a little uneasy, right? Very understandable to assume that for a lot of investors. I really want to step back and try to move the needle, so to speak, away from the short term, okay? And we talk about this a lot, right? Focus more on the long term. We understand it is way easier said than done when we're actually in the depths of the volatility. So I do want to step back and go back to a January 21st commentary that we released 2022 at the beginning of this year. And we titled it, Volatility Never Feels Normal. And we looked at numerous factors in the market, predominantly gauging how did the performance of 2021 potentially overshoot some excitement, some sentiment, things of that nature from the COVID recovery in 2020, right? Undoubtedly, the performance last year was stellar, right? With the S&P 500 gaining nearly 30% to the upside, had many wondering, even us, was that too much too soon? Potentially. The volatility that commenced at the beginning of the year allowed us to step back and really understand what happened. So, with that in mind, we're going to release this, by the way, as a refresher. I do want to make some comments on the overall adjustments that we did gauge and look into as that volatility started at the beginning of the year, in hopes of making adjustments that would benefit 2, 3, 4 years down the road. And we're seeing the benefits today, although it doesn't always seem like that in the very short term. So, Alisha, what I want to cover today is the 5 critical things we initiated, made changes to at the beginning of the year as a result of our assessment for potential volatility into 2022. And I want to preface that by saying we don't have a crystal ball, zero shame in admitting we don't know what's going to happen to the equity markets, yet we can build a fairly robust probability profile of that. With that in mind, walk us through a little bit on the allocations we adjusted and initiated in the U.S. sector to begin with, and then we kind of let's walk backwards from there as well, and how that's maybe benefited us so far this year.
Sure. Within U.S. large caps, we looked at the extended valuation of growth, right? So during that surge in growth, surge in retail sales, all of those surges that took place in 2021 after the pandemic, growth outperformed significantly, especially the tech sector. So what we did was we looked at the valuations of value, and we saw that there was really good opportunity there, especially as we look at an interest rate hiking cycle and the fact that growth tends to underperform during such cycles. So we shifted into value, and that has panned out really well for us so far this year, with value down, I believe, about 15% year to date, and growth indices down closer to 28, 29%.
Almost double.
Yep.
Yeah. And it's really important to point that out, because not only did we shift more into value relative to growth, but we funded that exposure from our mid-cap and small-cap allocations, right? A lot of those U.S. names in the small and mid-cap space, we funded that. And all that's to say that we didn't know that's exactly how things would pan out. We used the data to our advantage. We used the probability outcomes we generate internally to make those adjustments. And we're now looking at those adjustments for potential reversal into the next 12 months. It may not seem like that right now, but those are the small benefits that really pan out. Let's talk a little bit about the dollar, because we also made some adjustments to our international exposure at the beginning of the year. Walk us a little bit through that.
Sure. At the beginning of the year, we added a currency hedge position. So with rising interest rates, we see that the dollar tends to outperform. And then whenever we have geopolitical risks, such as what is going on right now with the war in Russia, typically the dollar is a safe haven, so we'll see flows coming into the U.S. So those two factors right now are really causing a surge of the dollar that we haven't seen in
decades.
Yes, in decades. Yeah. So, we're seeing very high weakness in the yen, the euro, the pound. And so that currency hedge position really benefited our portfolio, because as the dollar strengthens, that detracts from returns on the international side. But having that hedge in place is definitely helping us.
For sure. And, I think the path of the dollar is still yet to be determined. Certainly sideways is our best case scenario here, our most probable scenario. Some upside may ensue, but something we are keeping, we're apprised of at all times, rather. And you mentioned interest rates. In the same research piece that was released on January 21st of this year, we did release some research on the annualized return of the S&P 500 during Federal Reserve rate hike cycles. And out of the nearly 14, 15 cycles, only one of them resulted in a negative total return profile. And I want to stress that because, again, it is very easy to succumb to the short-term noise and volatility of what's happening. And certainly there's a lot of merit to that with inflation, with the war in Russia and Ukraine, with the monetary and fiscal adjustments happening in Europe, with everything else we're seeing here domestically as well. Stepping out of that can provide and has historically provided a better perspective for where things can end up 2 or 3 years down the road. And that's the message of today. Our finger is on the pulse. We have made tactical adjustments. We want to reverse those, capture the premiums we've been able to generate so far year to date, and allow that to pan out for our investors and clients over the next 2 to 3 years. So thank you, Alisha.